to me, I think the number one benefit for employing systematic frameworks, particularly through the lens of macro risk management, is that it allows you to sort of distill all the noise. There's so much noise out there with respect to investing, and we all have it. We all turn on our Bloombergs, and they tell us the top stories and the stuff that everyone clicks on, and you go on CNBC, you turn on Bloomberg, the TV, and it's there's so much noise out there in terms of the information that is being generated, but obviously not all of it is actionable, and most of the time, all of it it's actually quite harmful for you in terms of your ability, your reaction to some of that information. So distilling noise into signal, or defining signal amid all the noise, is probably the biggest benefit of having a systematic process.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode, Jack and I step into the macro world with Darius Dale, founder of 42 Macro. This is a wide-ranging conversation around economic regimes, asset classes, risk management, return expectations, and systematic methods for managing a portfolio throughout an economic cycle. Darius shares with us his method for developing macro-related investment strategies, and we talk about where things stand in today's economic environment and the changes he sees on the horizon for the economy and how that may impact certain asset classes. Anyone interested in learning and thinking about the macro environment will like this conversation. As always, thank you for listening. Please enjoy this discussion with 42 Macro's Darius Dale. Darius, thank you very much for joining us today.
Appreciate you guys, man. Thanks for having me on.
We're going to talk about macro investing, different macro strategies for different economic regimes. I think what we're seeing in today's market and economy, and also about how investors should be, I think, looking at or thinking about their portfolios and, quite possibly repositioning. But before we get into all that, I wanted to ask you if you could just sort of share your story, how you got to where you are today, going to Yale, playing football, getting into sort of this macro world that you're in. If you could just help our audience understand a little bit more your background and who you are, I think that would be helpful.
Yeah, no, I appreciate that, Justin, man. So it's more a function of just being in the right place at the right time. I know that's probably a cliche, when you ask questions like this, but truly my life is a result of a lot of happenstance. So kind of taking it, I'll be quick, but taking it back to my childhood. We grew up very poor. My folks were drug addicts, and so we were kind of constantly in and out of a home, in and out of homeless shelters and things like that. And I got very lucky and fortunate. Ironically, we got evicted heading into my third grade year, and I ultimately wound up going. We lived in a homeless shelter that was near a charter school called Del Mar Harvard, as indicated by the name. It was obviously a really good school, and so that 1 year of kind of charter schooling education really equipped me with the sort of acumen and the educational tools necessary to really stay ahead of my grade. So when I got back to the, I guess, quote unquote poor schools, if you will, I wound up being 2-3 grades ahead of my classmates. Really for the rest of my schooling, all the way through high school. So I was a very advanced student from that regard, in that respect. How I play football or sort of how I got to Yale kind of coincides with my career on the gridiron. Very reluctant career. I didn't want to play football. I was a nerd at heart. I actually was playing pickup basketball game and was going up for the story at this point is a dunk. It's probably a layup, but as I get older, the story was now it's like a 360 windmill between the legs dunk. It'll be me jumping through the gym roof 10 years from now. But I was going up to score, and I actually blew out my knee. And in that recovery process, I wound up gaining about 100 pounds over the course of the next year, because my leg was immobilized really for about a year. And I wound up being an offensive lineman. And it turns out I wound up being a pretty good offensive lineman and got the attention of some of the Ivy League schools, and ultimately chose Yale.
That's great. It's one of those things I think about with the education. It's like one change, which was a big change at the time, going to a different charter school, but that sort of set in motion. Just kind of reminds me like the butterfly that flapped its wings, and then this tsunami happens across the world somewhere, because of a little change puts you on a trajectory to go in a completely different direction in your life.
Absolutely, and I'm very fortunate for that. And look, I mean, markets are like that. Everything is like that in life, right? You don't know what can ultimately turn out to be a blessing in disguise. So it really, behooves us all to be prepared for those opportunities when they do show up.
So how'd you get interested in the markets and macro? I'm guessing in the football huddle, you guys weren't talking about like supply and demand.
No, not at all, man. Especially pre-crisis. I mean, like, anybody who's played, Ivy League football, certainly, I'm guessing most Ivy League sports will tell you the goal. You're basically sacrificing your college scholarship because the Ivy League doesn't have any merit-based scholarships. You're basically sacrificing the opportunity to get your college paid for free with the guarantee that some alum is just going to give you a job, on Wall Street or whatever industry you come calling in, and that was generally the case. Certainly was not my expectation, throughout the time I was on campus. But obviously 2008 happened. I graduated 2009, right? Kind of at the depths of the financial crisis, the depths of the Great Recession. And clearly that chain of command really broke down. And sort of how I wind up on Wall Street, specifically, during 2008, when everything's melting down, and then really into the fall of that year, our senior season, I noticed a lot of my buddies were actually getting their offers rescinded, or the folks that hired them, they couldn't get a hold of them because obviously folks are getting fired on across Wall Street, obviously particularly in Lehman. And so the reality is it became pretty clear that there was going to be a jobs crisis, and my former boss Keith McCullough, who runs Hedge Risk Management, being the astute trader that he is, puts out a full page ad in the Yale Daily News saying, "Hey, we're hiring." Kind of looking to build a firm, a research firm near campus. And ultimately, that was kind of my first job. I stayed there for a really long period of time, but took advantage of that opportunity.
It reminds me, not to just make this at all about us, but Jack and I, with Validea the first time around, it was like 98, 99, 2000. We were part of what I would call Validea 1.0, and how that, when you go through something like that, and then you're involved in something like the financial crisis, or you were kind of getting your first job sort of on the tail end of maybe coming out of that. We went through the dot-com boom and bust. We've obviously been through the financial crisis with our firms as well, but how those early experiences can be very formative and influence sort of the way that you look at things and your thinking, because that's the first thing that you saw.
Yeah, totally. You're absolutely right. I mean, so to think about like how I think about the world now, this very, rate of change oriented mindset, regime segmentation, all that stuff is not what your traditional sell side shop does, right? I kind of got the flexibility and the free reign to create a lot of process and source a lot of sort of, models and tie it all together, which was great, man. I really got to, I look back on that experience and realize like, hey, look, if I'd have just went to Goldman Sachs or, Morgan Stanley, JP Morgan, obviously those firms have incredible training programs, great analyst associate programs. But the reality is I would have just become another, economist automaton, like a lot of folks who sit in those seats. There's nothing wrong with those seats, right? They're highly paid, highly compensated, really thoughtful individuals. But, quite frankly, I don't think those are kinds of people you want helping you manage macro risk, because that's not really their role and their function in the marketplace. So, we got to build out a lot of really good process in my former shop and learn a lot and really kind of, again, as I mentioned, just tying a lot of stuff together as being force fed. A bunch of wonky material or something that kind of has been regurgitated across Wall Street.
Yeah, that's kind of the one thing that we were thinking about in terms of talking with you, is sometimes these macro forecasters get picked on because it's like they make predictions which are very hard. It's hard to, no one can predict the future. And I'm just thinking of like things like when all the strategists come out and give their year-end S&P 500 targets, and how far, and that's not what you do, but how far, they, in the end, they are away from hitting those targets. Everyone kind of is clustered around the mean, and then you have a couple outliers, and then when you look at the end result, like most were wrong significantly. So, I mean, to what extent do you believe it's possible to predict the future of the macroeconomy?
Yeah, absolutely. So, Justin, I'll definitely answer that question. Let me take a step back real quick and sort of and be kind to our friends on the sell side, right? Their job is not to effectively predict markets. Their job is to use as much information as they can, either talking through companies or iterating on and building models and things of that nature, to formulate a consensus in the marketplace. That consensus becomes the basis by which folks on the buy side manage risk. And so the kinds of, sort of models and solutions that the, traditional sell side economists or even sell side analysts on the equity and credit side, the kinds of models that they employ are really not designed to price risk well or understand, changing probabilities and things of that nature. They're more designed to sort of be explanatory, if you will. And so that to me is that's a critical feature of why you see a lot of forecast error from what's realized in markets versus what's predicted. It's not that these folks are not good at their job or not very intelligent individuals. They're extremely bright individuals. It's just that they're doing something very different than what I think ultimately we're doing as investors and people who are tasked with managing risk.
Yeah, that's a fair point. Thank you for that. I think one of the things that I wanted to try to talk to you about, and we're gonna kind of get at a more granular level how you go about the inputs into your model and how you utilize these things. But I want to ask you, I believe a lot of this is a systematic process. So here at Validea, we follow a number of quantitative models. We are strong believers in systematic investing. But from your perspective, what are the advantages of a systematic macro-based process and model?
Yeah, no, I think that's a great question. It shocks me that not everyone is doing it from a systematic standpoint, right? We've gotten a lot of good feedback and information from folks like Dalio. Say what you like about him or not, but the reality is he's built a very large, successful firm, systematizing macroeconomics and macroeconomic risk. And so to me, I think if we're going to do this well, we ought to be standing on the shoulders of giants, as I try to do here at 42 Macro for our clients. And so, to me, I think the number one benefit for employing systematic frameworks, particularly through the lens of macro risk management, is that it allows you to, sort of distill all the noise. There's so much noise out there with respect to investing, and we all have it. We all turn on our Bloombergs, and they tell us the top stories and the stuff that everyone clicks on, and you go on CNBC, you turn on Bloomberg, the TV, and it's there's so much noise out there in terms of the information that is being generated, but obviously not all of it is actionable, and most of the time, all of it it's actually quite harmful for you in terms of your ability, your reaction to some of that information. So distilling noise into signal or defining signal amid all the noise is probably the biggest benefit of having a systematic process. But I think a stealth benefit, and this doesn't really get talked about enough, but clearly I think we've all figured out that the Bayesians won the debate between Bayesian and frequency probability theory as it relates to investing and managing risk in markets. From that perspective, obviously, most of us are doing some form of a Bayesian inference process. We certainly consider ourselves to be doing that at a very high level here at 42 Macro, and having a systematic process really allows you to understand and really contextualize changes in the environment. You can spot changes much easier and spot inflections in critical variables much easier if you're sort of religiously being counting the data and sort of updating the models and iterating the models.
One of the challenges, at least for amateurs like myself in the macro space, is a lot of the major macro data we see, whether it's CPI or it's GDP, we're seeing that data a long time after it actually occurred. So there's that significant lag there. And I'm wondering how valuable do you think that data is in terms of predicting the future, given the lag it's presented with?
Yeah, no, great question, phenomenal question. And so clearly, when you're using data like GDP or any economic statistic or any company fundamental as well, right? I think it's a little bit different with macro than company fundamentals, because company fundamentals, you get less information on a consistent basis, whereas with something like economic growth or inflation, you're sort of getting information throughout the month that sort of leads you into the kind of the next major release or major set of releases. So it's different in that regard. But let's start with something like GDP. GDP is a very important indicator because it's obviously gross national product is what we all agree is the overall economy. And that agree function, in our opinion, is why we all sort of anchor on it as the sort of dominant unit for measuring the economy, measuring economic growth, because it's comparable across countries for the most part. There's some methodology differences, but for the most part, we can all agree across borders that this gross domestic product is what we're all trying to sort of look for. Now, that doesn't necessarily mean that gross domestic product should be your dependent variable in a model, or your main variable that you're using to forecast for the markets. We actually don't forecast GDP. We interpolate our forecast for something like the composite leading index time series as a proxy for GDP, because one, that data series is monthly, so we're getting more higher frequency updates, and so we're able to update our models and readjust those forward-looking probabilities more consistently, much faster, with much less sort of big jump conditions in that process. And then secondarily, it tends to lead. So what we're trying to do is find predictors that lead to things that everybody cares about. And what we know is that the composite leading index time series, again, which we use to forecast growth, tends to lead inflections in the GDP cycle, in the year-over-year rate of change GDP cycle by 1 to 2 quarters. And so that's why we tend to anchor on that. The inflections in momentum in growth and inflation in particular, which again is the hallmark of our regime segmentation process at 42 Macro. Those inflections and that momentum, are what markets are using to price in, dispersion across asset classes and dispersion within asset classes.
Yeah, you mentioned your process a little bit, and you've developed a really interesting grid process here where you kind of look at growth and inflation and sort of divide into 4 different grids. I wonder if you could talk a little bit more about how that works.
Yeah, absolutely. So, great question, Jack. So, our regime segmentation process, as mentioned, is really it is dominated by understanding changes in growth and inflation. And what we're trying to do is identify sort of what state of the economy is in from the perspective of the trending impulse in growth and inflation. So there's 4 distinct states you can be in as a function of marrying those 2 variables. The first state is where growth is trending higher and inflation is trending lower. That's what we call Goldilocks. From the perspective of asset markets, that tends to be sort of risk on with a disinflationary bias. The second state is when both growth and inflation, that impulse is positive simultaneously. That tends, from an asset market response perspective, that tends to be risk on with a reflationary bias, an inflationary bias. The third state is what we call inflation. That's where the growth impulse is negative on a trending basis, but the inflation impulse remains positive. The asset markets tend to be risk off with the inflationary bias. And then lastly, what we call deflation. That's where both the growth impulse and the inflation impulse are both negative. The asset market response is typically risk off with a disinflationary bias.
When you sort of look at the grid system, is it just as important to figure out sort of where we're headed in the grids as well as where we are, or do you really focus on where we are right now?
Yeah, so both. You need to understand where we are, and the hallmark of our process for helping investors construct portfolios, balanced portfolios that are designed to take advantage of macro risk to the upside and to the downside, is understanding where we are today, the kinds of securities and exposures that are likely to do well today, or vice or poised to do poorly today. To the extent you can't have short exposure in your fund or your portfolio, and then understand the likely change in the economy, and moreover the changes in policy, because policy is a big factor of what we, in terms of quantifying changes in policies, is something we're really keen on doing here at 42 Macro, because it has a lot of impact in determining asset market dispersion. Again, it's important to understand where we are today, because that'll explain a lot of the sort of dispersion you see today on your screens, or the anticipated dispersion over a short window of time. And then when you understand where we're likely headed, you can then start to construct portfolios that are designed to take advantage of some of these changes, these big changes. For example, going from reflation to deflation. That's a pretty big sea change from the perspective of the kinds of securities and assets you want to be long in your portfolio, and long and short. It's more or less the polar opposite of each other. And so understanding that economy can make such a pivot over some forecastable time horizon, everything we talk about is usually under a year. From the perspective of managing risk, we obviously have longer term views, but they really don't influence our portfolio construction. But understanding how the economy might evolve over that sort of medium term duration can be extremely valuable to an investor. Not chasing certain assets that have a short shelf life, really sizing up and grossing up assets that potentially have a long roadmap for positive performance. Getting rid of things from your portfolio, or taking down your exposure to the positions that are unlikely to do well or outperform. That having all that color from a growth and inflation impulse perspective, from the impulses within monetary and fiscal policy, understanding all that and how they have historically influenced asset markets is extremely powerful in terms of the size of positions you put in your portfolio, and obviously the exposures therein.
Taking that same question and looking at the current situation, where are we now on the grids, and sort of where do you think we might be going, say in the next 12 months?
Yeah, great question. So right now we're in inflation. We have been in inflation for the balance of the second half of 2021. So as I mentioned, inflation is the grid regime where the growth impulse is negative. It's been delta negative on a trending basis really since July of last year. And inflation impulse continues to be positive. That we've been obviously, inflation is the number one, two, and three headline on most financial news media outlets, and so it's no surprise that inflation is trending higher. But the growth impulse being negative is something that really started to get priced in asset markets from a sector and style factor leadership perspective. Kind of going back to the June of last year, and it's certainly starting to get priced into the credit markets. Dating back to kind of December, January of this year, last December as well. And that's something that we think will continue to get priced in as the economy. And again, this is not just the U.S. economy. This is a global phenomenon as well of transitioning from inflation to deflation. And that's again where both growth and inflation are slowing simultaneously on a trending basis. Our models have that commencing sometime around late Q1 or early Q2 here in the U.S. economy. Roughly thereabouts the same for the global economy as well when you kind of anchor on Europe and Japan. And the reality is that may bring on a secondary set of market risk, in and around kind of this transition of potentially slowing through and potentially to and through trend from a growth perspective, because that's certainly something our models see as a reasonably probable scenario. Whereas consensus expectations is something we can unpack later in the discussion. Consensus is still very much elevated with respect to its GDP and its EPS forecast.
I think you said in a different interview you might see some risk of maybe even say like a 20 or 30% decline at some point this year in the market, right? Given sort of the dynamics and where they are.
Yeah, no, I think that's a I think that's a very likely scenario. So there's sort of in terms of so let me start by saying one, you should be thinking about being more defensive in your portfolio when we talk about being in either inflation or deflation to begin with, right? These are the grid regimes, and we've back tested, everything 6 ways through Sunday from the perspective of our grid regime process. We understand, expected returns by asset class or by exposure. We understand percent positive ratios when you're in certain grid regimes or certain styles of grid regimes, i.e. being in a deflation with a quantitative tightening bias, which is obviously is exactly what we're likely to have happen, throughout the balance of this year. We understand, sort of what volatility and covariance are across asset classes, again, through the lens of that process. And so understanding those four critical features, again, expected returns, percent positive ratios, volatility, and covariance allows you to very, cogently understand, kind of the risk reward setup for an exposure. And more importantly, the risk reward setup for a given subset of exposures, i.e. if you're an equity PM, what sectors and style factors are poised to do well, and how should they handle this transition to, deflation over the medium term? What fixed income sectors are poised to do well, what types of currencies are poised to do well, things of that nature. And that's something we make readily available and publish as part of our research, because to me, I think that's what macro risk management is understanding the dynamics in the economy that actually influence asset markets, and more importantly, influence them across cycles to a considerable degree. Obviously, on any given trading day, Putin and Biden, or forget the guy's name in Germany, I'm blanking on it, but Macron in France, any given day, what they say can have an influence over markets, from a geopolitical standpoint, or you get these squirrely things like the Robin Hood squeezes and all that stuff. But that stuff tends to be more sort of episodic. And what we're trying to do, obviously, in helping investors understand these big macro risks, is try to find things that cause markets to trend, cause certain dispersion patterns to trend. And that's exactly what we think. What we think will trend is the market pricing in deflation plus rate hikes plus quantitative tightening plus fiscal tightening. Each of those subcategories all has its own back test, and they're all built into our expectations for market risk.
I want to ask you a little more about portfolios construction. I'm probably misquoting you a little bit, but one of the things I think you've said is it doesn't matter if we're in a bull market or a bear market. What matters is that you're in the appropriate assets. And I know with a lot of macro forecasters, you'll get these forecasts, but you won't necessarily get how do I combine all this together into a portfolio I could use. So I'm wondering if you could just talk a little bit more about how you think about the process of constructing a portfolio using the information you have.
Yeah, absolutely. So that's a great question. So let me start by saying, that quote I think is a very underappreciated quote, of mine. I'm probably biased, but taking my biases at face value. What I really mean is that, this characterization of being bullish or bearish is one, a misnomer, and two, I think it could potentially be dangerous, particularly when you're talking about retail investors, because they tend to be, sort of overweight one central theme, or even worse, overweight one central duration in terms of the risk that they're taking in their portfolio. And I think I think most institutional investors will understand that's generally a bad idea. Portfolio should be a combination of themes and probabilities and a combination of durations, by which you're trying to sort of exercise and extract risk premium from the market. And so that's what I really mean by that statement is that, hey, being bullish or bearish implies that you only have one theme in your portfolio. And how we think about constructing portfolios is through the lens of our grid regime process. What are the highest probability grid regimes that are, based on, or so obviously there are 4 grid regimes, but, what are the probabilities associated with realizing, any one of those 4 grid regimes over the medium term? If we have 100% probability, at least according to our models, of, heading into grid A or B, then we'll be, 100% allocated to grid A or B, because we think that's the highest probability outcome over the next 3 to 6 months. And we're kind of constantly on a rolling 3 to 6 month look forward. But however, there are times, and certainly this was the case throughout the second half of 2021, where the distribution of probable outcomes is fairly flat. With the probability of being in what grid, Goldilocks or reflation, inflation, deflation, they're all fairly clustered in terms of losing, impulse, losing momentum from growth and inflation, i.e. they're not moving in a big direction in either direction, moving in a big material magnitude in either direction. And so, we really try to allocate across the 4 grid regimes in our portfolio construction process to account for that, kind of that flatter distribution of probable outcomes. And then when you're talking about security selection, so what we're trying to do with security selection is identify, sector style factors, any exposure, any macro exposure that can be clearly and cogently represented, kind of through the lens of, understanding, what's its relative volatility and covariance versus the broader subset of things that I'd want to be long or short in a particular regime. What is its, relative expected value and percent positive ratio of things that I want to be short, or long or short relative to the other subset of exposures in that particular regime. And we reduce it all, reduce all the dimensions for all these things to help investors visualize it very clearly and cogently. And ultimately, when we put everything together, let's say, hey, look, right now our process is saying the dollar is a thoughtful long idea, or long-term treasury bonds is a place you want to be starting to allocate to from the context of pivoting to a deflation regime over the medium term. Right, like so, if you long-term treasury bonds, you put $1 in there. Obviously, you put some defensive equities in there. These are all different asset classes, and this is the tricky part when you're talking about constructing portfolios across asset classes, because clearly certain assets have higher volatilities, higher covariance with equity beta, credit beta, things of that nature. And so, what we try to do to minimize that sort of overall risk of the portfolio by not overly allocating to the wrong kinds of assets at the wrong time is we have what we call our volatility adjusted position sizing process. And what we're trying to do is understand relative semivariance between each of the exposures in the portfolio construction. For example, if an exposure is in the upper third of semivariance for that particular sample of exposures that we have represented at any given time, we'll have that be a 3% position. If it's in the middle third, we'll have that be a 6% position. If it's in the lower third of semivariance, we'll have that be a 9% position. So we're constantly allocating to having bigger weights to the exposures that have sort of lower downside deviation risk.
Yeah, and there's a huge lesson in that too. Not putting all your eggs in one basket, or not making huge bets on one thing. The idea of having a whole process that constructs a lot of ideas together is, in anything you do, and what we do too as factor investors, it's such an important thing.
Totally. Yeah, you guys do really well as well. You guys, I love, you guys. What strikes me is really cool about what you're doing is you're constantly learning from the market, sort of like how to evolve your portfolio construction process. I've certainly got some of those messages from you guys in recent months, which is, look, like we think we can try to figure out this. I think what we're talking about right now, portfolio construction, is sort of the last and final frontier of finance, if you will, because there are technically no right answers. We've not proven any one particular thing to work all of the time. And so as a function of that, as a function of the markets constantly changing, constantly adapting, and giving investors new signals and punishing them for relying on stale signals, this is always going to be a moving target. But I think generally some of the more generally accepted principles of what you guys are doing, what we're doing, is obviously sort of having your positions be inversely correlated to whatever unit of risk you might think it is, however you quantify risk. We use semi-variance as obviously as our guiding factor, but other investors use different tools.
Before I hand it back to Justin, I just want to take a quick tour through the major asset classes. And based on sort of what your outlook is right now, I want to see what your thoughts were on each one of them. You've sort of talked about equities a little bit already, but I'm wondering beneath the surface in terms of factors. I mean, what factors do you expect to do well going forward?
Yeah, absolutely. So in terms of going back to that portfolio construction process and our grid asset market backtest process, what we're really trying to do is sort of identify, based on what our models are signaling, based on forward guidance out of the Federal Reserve, observed guidance out of the Treasury Department, and we can do this for any economy, just sort of looking at changes in fiscal and monetary policy, is ultimately understand kind of the fiscal and monetary policy dynamics that should go along with our projected kind of path and magnitude of change for things like growth and inflation. And so when you think about all the sort of things we can program into the system, that'll sort of give us the relative, again, expected returns, percent positive ratios, volatility, and covariance across each of these exposures. What we're looking at is, hey, what's the grid regime we're going to be in? What's the speed of the change in growth? What's the projected speed of the change in inflation? Sort of what's the Fed doing with its policy rate, or central bank doing with its policy rate? What's the central bank doing with its balance sheet? What's the fiscal authority doing? And then lastly, what's the rest of the world doing? And right now, answering each of those sort of questions is, hey, we're heading to deflation. That's growth and inflation slowing simultaneously. We'll have a -2 sigma delta on growth, and what that means is the projected deviations in the growth from the trend are likely to be roughly 2 sigma relative to the sample, relative to the trailing 3-year sample. And so we're talking about an expeditious slowdown in growth. We're talking about a -1 sigma delta on inflation, and so that applies a moderate deceleration in inflation. Inflation, i.e., inflation remaining decelerating but remaining stickier than probably, and not probably, our models would say they are likely to remain sticky. Inflation is likely to remain stickier than most economists expect. Obviously, the Fed's hiking rates, that's getting priced into rates markets. Clearly the Fed has given us enough guidance on quantitative tightening to understand that it's probably going to be here as soon as April, or certainly by May or June. And then lastly, we're going to be in a fiscal contraction for at least the next couple of fiscal years. So thanks to a record ill-advised stimulus package that we received in March of last year. So we know all these dynamics, and more importantly, we understand how each of these dynamics, because again, these are all rate of change facts. There's nothing I said is qualitative. We know the direction of travel for growth. We know the magnitude of change in the impulse. We know the direction of travel for the policy rate, the direction of travel for the balance sheet, direction of travel for the fiscal balance. All these things can be back tested. And we've created time series for all these things to back test asset markets, again, through the lens of volatility, covariance, respective returns, and percent positive ratios. And so programming all that information in, it'll tell you, sorry, getting a long-winded answer to your question, it'll tell you that, sort of from a style factor perspective, low beta is clearly, head and shoulders one of the best places you can be. High dividend is also another place you're going to want to be. There's pockets of, the markets that may be okay to survive. Clearly, there's this rotation into value. But our process would say, there's pockets of value that might work, but one of the kind of places that we think investors might get caught wrong-footed, by the time we get into the spring and summer of 2022, is this sort of chase into high beta cyclicals. High beta cyclicals are precisely the wrong part of the market that our process would suggest you're going to want to be long. Kind of whatever the opposite of a high beta cyclical is the kind of exposure you're going to want to be long if you're talking about managing, kind of the next 2 or 3 quarters of risk.
Everybody seems to hate bonds right now. And I think from listening to you, and correct me if I'm wrong on this, I think you're a little bit more constructive on bonds than most people are. So I'm wondering if you could talk a little bit about your outlook for bonds.
Yeah, absolutely. So there's, it's kind of taking it away from the grid regime process, because that process tells you to be long bonds here now as well. Taking a step back, just thinking about where we are in the inflation cycle. There's only one thing and one thing only to do when inflation peaks, when reported inflation peaks, and it's buy bonds. It's pretty simple. You go back to, as recently as Q4 18, you go back to sort of, Q1 of 2015, you go back to, kind of early 2010. There's all these opportunities, and, sort of throughout my career, and, we can take this back as far back as the data goes, to say, hey, look, when everyone is clearly and readily understanding, that inflation is a problem, or that, the Fed is recognizing that inflation is a problem, the next step is to play it forward in terms of the Fed's response, the economic response to both Fed tightening and inflation itself, because inflation itself has impacts on the economy as well. And the result is that we see a sort of downside deviation in GDP in growth from its trend, and that has historically been a very, very positive signal from the economy for investors on the long side of bonds. And so, it's always hard to hold your nose and make those calls. I mean, I'll give you a story. Back in Q4 18, we were making a kind of a similarly styled call back in my old shop in terms of saying, hey, look, growth and inflation are going to slow. The Fed is likely to continue tightening. Maybe a little bit less robust in terms of all the numbers and understanding it all, but very similar style call that we're kind of making today, which is, look, we're at the peak of the inflation and growth cycle, and everyone's short bonds, but all these dynamics that have caused investors to be short bonds, and again, we were short bonds throughout most of that time as well, that cause investors short bonds, like i.e. accelerating growth, accelerating inflation, fiscal monetary tightening, all these things are really, really unsupportive of bond prices. Those things were all starting to get peeled back at the margins. And so that, in our opinion, is something that a very similar setup exists today.
I may know the answer to this one already based on your idea of inflation peaking, but a lot of people, as much as they hate bonds, love commodities right now. What is your outlook for commodities?
Yeah, absolutely. So commodities, if we're talking about, and again, I mentioned this, and I'm sorry I didn't answer your question earlier. If we're talking about a potential, and again, I mince no words about this, I think it's very easily that we could see a 20 to 30% decline in the S&P 500 in 2022. Will we see one? I think that's up for debate, very clearly up for debate. But it's certainly the conditions exist from the perspective of positioning, where we are in the business cycle, from the perspective of valuations, and ultimately from the perspective of the grid regime process we just talked about, to see a 20% decline in the stock market. And so, if we're talking about something like a crash in the stock market, it's very unlikely that we see commodity prices survive that, because again, these are among the highest beta of risk assets investors have in their portfolios. And so, folks are losing money in their equity portfolios. They're not buying more copper and palladium and corn. They're probably selling those things at the margins, just to raise cash, or kind of take down their overall risk. And so, the reality is you're probably unlikely to see commodities do particularly well. But we've done a lot of work on this from a secular perspective. And then this is one thing that chaps my butt, if you will. I won't use the A word, but it really chaps my butt, because again, we have all these investors. I hear all these podcasts, and I certainly see it on Twitter, on finance Twitter. Everyone's in the inflation camp, the secular inflation camp, and no one's quantified what that actually means. Like, how much more inflation are we going to get relative to the previous trend? And that, I have yet to hear one investor actually say that. And so, being fed up with this sort of narrative-driven investing dynamic around inflation, we've taken it upon the liberty to ourselves to create a very advanced dynamic factor model to understand, hey, where has the stationary mean of inflation trended towards? And right now, our math is saying that's somewhere around 2.4 to 3% on headline. That's a big deal, because headline, the previous stationary mean, at least the mean of the prior decade, was 1.8%. So you're talking about not quite a double, but certainly a material deviation higher in the stationary mean of the time series. And so that means commodities as an allocation to the median investor portfolio needs to go up relative to the decade that we just exited. It means digital economy exposures, intangible assets, needs to go down relative to the previous decade. But that doesn't mean that at every interval we need to price that in. Right? The inflation is still going to cycle. It's still going to go from 7.5%, at least according to our math, to roughly around 4% by the end of the year. And that, in our opinion, is a negative impulse for commodity prices and commodity price speculation, which is really the critical dynamic, because it's not about whether or not there's supply and demand imbalances. It's whether or not there's supply and demand imbalances in investor behavior and their willingness to chase an asset class. That's what matters to price.
If you told me a couple years back that inflation was going to trend way above what people thought, I would probably have said gold's going to do really well. And it turns out gold has not done really well. And I'm wondering why you think that is, and what you think the outlook for gold is going forward.
Yeah, so there's two answers for that. One, I think it's got competing assets now. Digital currencies, crypto, all that kind of stuff. Certainly, it's probably taken some wind out of the sails in terms of gold flows, right? I mean, think about kind of where the gold industry has really tended to. It's become fear mongering videos to scare baby boomers and Gen Xers into allocating to gold relative to stocks. Well, those fear mongering videos don't work on millennials and Gen Z investors because we have crypto. And so I think that's part of the reason why there hasn't been as much sort of positive response to what had been a pretty aggressive decline in real interest rates. Going back to the middle of last year. On the sort of, so that's one dynamic that's probably weighed on the gold price. I think there's a more tinfoil hatty dynamic, if you will. Again, I limit myself to sort of one tinfoil theory per year, and I think central bankers broadly around the world are likely leaning on the gold price. Just if you run any sort of regression analysis, even the most cursory, linear regression model will tell you that the price of gold should be somewhere around $2,100, $2,200 right now. And so the fact that we aren't is telling you that there's some forces in the market that are presenting that or are preventing that. In my opinion, I think that the easiest thing that a central banker can do to sort of weigh on, prevent, inflation, runaway inflation fears, getting entrenched in society, is leaning on the gold price, making sure that gold is not on a parabolic ascent, and all the marketing around gold being on a parabolic ascent itself is on a parabolic ascent. So that's my tinfoil hat explanation to answer your question there, Jack.
And just finally, one more before I hand it back to Justin. Given that it's a high beta asset, I probably know your answer to this, but what are your thoughts on crypto?
Yeah, no, I mean, look, so my thoughts on crypto, and I think you can extrapolate this from my thoughts on the broader market. One thing that we have to contend with, in the middle of this sort of transition from going from inflation from a bottom-up macro regime perspective to deflation is the dynamic, there is the likelihood that growth has a sort of transitory positive impulse as a function of rolling off of Omicron. We're already starting to see that in some of the leading survey data, although not all of it is robust. But generally speaking, we're starting to see leading survey data unthaw in the month of February, and that's likely leading a sort of an actual sort of acceleration in some of the lagging hard data, either in February or March. That's something that could last into the spring. We've long thought that Omicron was likely to be the sort of variant that transitions COVID-19 from the pandemic to the endemic phase. Now, I'm not sure. I'm more than not sure. I would take the other side of the consensus expectation embedded in growth forecasts that the transition from the pandemic phase to the endemic phase results in this big consumer spending boom and this big economic boom that that needs to be tapered and toned down by fiscal monetary tightening. We don't see that boom as a likelihood, as a high probability scenario. In fact, we've got about, at least in our most recent slide deck, which you do on every month, 130 slides that really take the other side of that view. But that doesn't mean that the data is unlikely to improve, for 1, 2, 3, potentially even 4 months into the springtime off of these sort of bombed out December, January lows in some of the data. I mean, real consumer spending contracted at a 12% annualized pace in December, right? Like this is in the world's largest economy. So I mean, there's a setup here for data to bounce and for things like Bitcoin, cryptocurrency, for high beta risk assets to trade to a lower high before they ultimately give up the ghost again. And I do believe that is the most likely path forward for asset markets. But in terms of quantifying some of that downside risk, we look at things like household equity ownership relative to net worth. Where we are in that cycle says we got about 30% downside of the market. Things about the business cycle, consumer expectations around the labor market. Where we are in that cycle says we got about 36% downside of the market. And lastly, if you look at it from the perspective of valuation through the real earnings yield in the S&P says we got somewhere between 30 and 35% downside of the market. And again, these are just looking at median drawdowns relative to sort of prior trigger points and prior cycles, and we're very much at trigger points for each of those indicators now. And so I worry about the market risk associated with the economy that is potentially set up to materially disappoint consensus expectations, potentially slow much faster than investors realize already based on some of the tightening dynamics that have already been priced in. And then secondarily, you have a Federal Reserve that's hell-bent on chasing a lagging inflation dragging, looking backwards and driving the car backwards, that is potentially not abreast or aware of or even in a position to respond to some of these risks to the growth outlook.
Darius, we're a couple minutes into the fourth quarter, so we're doing, I think, pretty good on timing here. I wanted to kind of pivot here and ask you a little bit more about the Federal Reserve and their response to the financial crisis in terms of interest rates, quantitative easing, monetary policy. Sort of just get your sort of sense and evaluation on that. And then as a secondary question, I'm going to try to put both of them in here. when you look at what the government did in terms of the fiscal stimulus with COVID, I mean, you mentioned something earlier that maybe that stimulus that came in 2021 wasn't needed. What your evaluation is there, and then if you could also talk to, if you have an opinion on, has this introduced some additional risk, or has this introduced sort of a change in the market where maybe investors' expectations, the market's expectations now think, well, the Fed's going to just, obviously they have interest rates, but the government's going to come in and just bail us out the next time we get into some sort of trouble. So do you have, what are your just general thoughts on that stuff?
Yeah, so there's sort of three questions there. So starting with the monetary response post crisis, I think we blame the Fed a lot. I certainly did early in my career. I was probably a young, I guess, I don't know if I'm young millennial or not at this point, 35 or whatever that means at this point, but certainly back then, early in my career, having been someone who spent a large part of my life very extremely poor, waiting around in food bank lines and being evicted several times. I understand like the sort of dichotomy between the haves and the have-nots in this society, and certainly saw the Federal Reserve and their incessant QE as a real kind of contributing factor towards perpetuating a wider dispersion between the haves and the have-nots in society. So I was very angry at the Fed. Kind of early in my career, I found myself constantly reading von Mises Institute materials and siding with Ron Paul and a lot of stuff. But the reality is, as an investor, that's neither here nor there. What we're trying to do is make money and take advantage of macro risk and ultimately risk manage some of these macro risks in an effective manner. And so once I got kind of out of that mindset, you start to realize like, hey, look, this is really just a game that they have to play as a function of the political dissension and discord down in D.C. Right? Like we can't get the Democrats and Republicans to agree that the sky is blue, let alone on any piece of material fiscal legislation that could kind of address some of these imbalances in society and really plot us a better path forward from a productive capacity standpoint. So clearly we weren't getting any really good fiscal policy. So the Fed, in response to every growth slowdown, in response to every tightening of financial conditions, really was the only game in town. And so I'm not even sure that it's really Bernanke's fault or Yellen's fault or Jay Powell's fault. It's really just we kind of dumped the bag on them, right? We kind of tossed the hot potato to them and ran out of the room. And that's unfortunately, and really it's just a function of the fourth turning dynamics. How my former colleague, is clearly one of the world thought leaders in some of these generational cycles, if not the preeminent thought leader in some of these generational cycles. And he'll be the first to tell you that, hey, look, we're in a fourth turning, and this sort of political dissension that we're seeing down in D.C. and our inability to get major legislation done is a symptom of being in a fourth turning and a symptom of kind of these generational imbalances that have accumulated in society over the previous kind of 80 to 100 years. And so that's exactly where we are. We're going to need to see bigger legislation, bigger solutions to some of these big existential threats out there. Obviously, inequality is one of them. Climate change is one of them. I'm sure there's a bunch of other that I'm missing. But the reality is the Fed is slowly trying to hand that baton to fiscal policymakers. But the reality is they're not going to be able to do that until we get a big enough crisis to catalyze that big change in fiscal policy. And sorry, what was the second question, the third question?
It was just the response to the pandemic and the fiscal stimulus, and then what type of risk has this introduced here?
Yeah. So this is why that package in March was such a stupid idea. Congress finally got aligned in a way where that you could actually push through meaningful legislation that would actually address and tackle one of these big issues in society, whether it be sort of inequality or a climate change. But the reality is, I don't really understand what caused them to do this, but it seemed like they panicked and just wanted to sort of get a big win early on in the Biden administration by sort of authorizing another $2 trillion of fiscal spending that effectively amounted to just consumption. Just governments issuing investors treasuries in exchange for consumers getting money to spend on incremental goods, because obviously the services economy remained quite depressed. And so to me, the fact that they sort of opted for that style of spending as opposed to more thoughtful, longer term spending that could really address some of these major issues and really contribute to the productive capacity of the economy and support jobs from a longer term perspective, to me is just a big miss. It's a big no. There's no other way that you can describe that policy And really that policy itself was just a result of the federal authority, the fiscal authority, really underestimating or sort of overestimating the productive capacity of the economy at that time. You're giving investors, you're giving not investors, consumers, incremental money to spend in a time where the productive capacity of not just the U.S. economy but the global economy was really depressed as a function of the pandemic, was quite frankly a really dumb process. It's dumb in the context of their longer term objectives and some of the longer term things we need to get done as a society. And it was obviously dumb from the perspective of that productive capacity as well. So that's what I think about that.
I want to ask you about the Fed's tools to deal with inflation. Before the COVID crisis hit, I was listening to Ben Hunt of Epsilon Theory on a podcast, and he said something along the lines of, there's no deflationary crisis that can bring the market down. Because no matter what deflationary crisis we get, they're going to throw everything they can at it, and it's going to bring the market back up. And he was sort of proven right in the COVID situation. I mean, we had a quick decline, and we were right back. It seems like the tools are maybe a little more challenging on the inflationary side for the Fed because you have these consequences in terms of they could slow the economy. The market could, may react very negatively. What do you think about the Fed's tools to deal with inflation and sort of, what they have available to them and what the potential consequences of that will be?
Yeah, their tools to deal with inflation are much more powerful than their tools to deal with deflation. I mean, the problem with dealing with deflation is eventually you hit the lower bound of the policy rate, and you have to result to sort of more indirect measures of controlling the supply and price of money, i.e. quantitative easing, forward guidance, regulatory policy in terms of, lending ratios and all that stuff on bank balance sheets. It just becomes a lot harder to sort of, fight the good fight, if you will, if you're trying to stave off deflation. Fighting inflation is easy. You can take the policy rate to infinity. You can contract the balance sheet back to zero. I mean, they can get rid of inflation as quickly as they want because ultimately their tools to deal with inflation are pretty obvious. They're designed to slow the economy. They're designed to weigh on excess demand relative to the productive capacity of the economy. The Fed, as a function, in my opinion, as a function of the November jobs report and the October CPI data, which both came out after they sort of outlined their path towards tapering, as a function of those data points, the Fed basically said, hey, look, we have to reassess our expectation, our views on what the productive capacity of the U.S. and global economies are. And obviously in that reassessment, they realized that, hey, look, this sort of labor shortfall analysis, this framework that we've been anchoring on to maintain this pretty wacky, aggressive monetary policy in the context of an economy that's growing, several deviations above its trend growth rate. To me, I think that's when that really catalyzed that big sea change. And ultimately, because of that reassessment, it really means that all they can do is slow growth, right? Like that's the only solution is taking the economy, taking demand out of the economy so that it matches the level of supply in the economy. And ultimately, that's what they have to do, if only because of their forward guidance function. Rates markets have already priced in basically, terminal Fed funds rate of 2%, and so, or maybe a little bit more at this point after Bullitt's comments last week. And so the reality is they have to do that stuff if they want to be successful in combating inflation. Because if they don't do what the markets are pricing in, then that'll effectively result in an easing and obviously add fuel to the fire. And I just don't think the political sort of scope or space, there's no political space for them to add fuel to the fire on inflation right now. They can't be observed or seen by the general public as making this thing worse. Obviously there's no real recourse from that perspective. But again, I just think these are human beings who, have their own Twitter accounts, or at the bare minimum, they're reading the Wall Street Journal, and, they understand that their impact on society is pretty great. And quite frankly, I just don't think that they want to bail the stock market out anymore, right? I mean, at the end of the day, they've achieved a lot of their objectives in terms of, kind of promoting maximum employment, within the context of the pandemic. And obviously, inflation is well above their target level. So, there's really no reason for them to be as dovish. And one thing I'll also say on this, I keep hearing from a lot of different investors or, throughout these different podcasts I listen to and everything, the bull case can't be that the Fed's going to pivot after financial conditions tighten. Like if the stock market is down 30% and the Fed pivots back to dovish, that can't be the bull case. The bull case that's a buy the dip case. That's a buy the dip, at the Fed put case. The bull case, in my opinion, would have to be the Fed pivoting dovishly and fanning nominal GDP growth, obviously through the lens of more inflation. But I'm not convinced that we can actually have that. I think they're damned if they do, damned if they don't, because the economy is very clearly, if you look at the most recent consumer confidence data, 10-year lows on headline consumer confidence, basically 10-year lows on consumer assessment of their financial health, both relative to the previous year and also, from an expectations perspective. Obviously, we're basically a 15-year high in inflation expectations. This economy could slide into recession if the Fed doesn't get inflation out of control. And so the better solution would just be tightening us into what hopefully is a manageable slowdown, versus sort of not doing anything and allowing the economy to devolve and degrade on its own, because clearly that's the kind of the problem that I don't think the Fed's going to be able to solve if they don't have any space and scope on their balance, or from a perspective of monetary easing. Right? They're still at the zero bound. If we slide into recession anyway as a function of these inflation processes, getting unglued, then what's the Fed going to do? Like, are you going to take the balance sheet from 9 trillion to 18 trillion? Maybe they can, maybe they don't, but I think they probably would prefer not to do that and would prefer to provide the illusion that they remain in control of the situation.
Darius, thank you. So there's a lot to unpack here. A lot of interesting, I think, valuable thoughts that are important for investors to think about. Your systematic process to investing, I think, is going to be very valuable for people to learn and educate themselves on. But we like to ask our guests sort of one standard closing question. It might bring you out of the macro world a little bit, but maybe not. But the question is based on your experience in the markets and the research, if you could impart one piece of wisdom or teach one lesson to your average investor, what would that be?
Well, that's a phenomenal question. Love that question. And this is something I've learned, kind of thinking about the world through a rate of change lens, really for such a long period of time, and understanding kind of the impact of rate of change on asset markets and ultimately policymakers, is the lesson would be to respect the x-axis. I think a lot of times as investors, particularly in the context of valuation, there's a understanding of kind of vulnerabilities, whether something be overvalued or or there's an understanding of opportunity, whether vulnerabilities if something's overvalued and opportunity if something's undervalued, or you see these charts, kind of like here's a PMI with a 6-month lag and an inverse triple log this, and it has this perfect back test fit to this dotted line going forward, and it's good or bad, and it perfectly supports the author's thesis, right? And the reality is a lot of those a lot of the analysis we do as investors gives us a lot of confidence to make decisions. But the reality is we often forget that, hey, when you talk about constructing a back test on a particular analysis or on a particular model for the economy, you have to respect the amount of time that it takes to achieve that. Right? You talk about something like valuation. Generally speaking, at least all the work I've done on valuation, I stopped really doing it, kind of 5 years ago, because it became very irrelevant to like our investment duration, and it still is generally relevant to our investment duration, which is valuation doesn't work under 1, 2, 3 years. 3 years and beyond, you typically start to see valuation have a material influence on financial markets. But generally speaking, something can remain over or undervalued for several years before it really starts to get influenced again by some of those positioning dynamics. And I think it's like that with the econometric models as well. I mean, I've seen that so many of these charts where the author finds this one time series and overlays it with another time series, and the one time series that leads the other time series by 12 to 18 months is already in place B, and it implies that the time series B has to go to place B over some duration, and they say, oh well, I'm bullish or bearish as a function of that. Well, doesn't it imply that there needs to be 18 months of time to pass between us getting from point A to point B, right? I mean, I think that's the one thing that I think it's kind of lost when we see these pretty charts. We see pretty valuation setups, or pretty anything in financial markets, which is it takes time for those things to be realized, understood, appreciated, and priced in. It's often several months, several quarters, if not a few years of time. And as my friend Mike Taylor, a portfolio manager at Millennium for a long time, that's a couple careers away. I mean, this game has gotten really hard, and there's a lot more turnover and violence in financial markets, both on a intraday and a year-to-year basis. And if you don't respect the x-axis, you can wind up really being positioned in the wrong themes, in the wrong exposures for an extended period of time, and that to me is no bueno.
All right, thank you so much. Where can people go to learn more about you, follow your research, maybe your Twitter handle?
Yeah, oh, thank you. I appreciate you guys. I'm at so we're at 42 Macro. So we fancy ourselves to be kind of one of the thought leaders out there from the perspective of helping not only institutional investors but also retail and RA investors manage macro risk. Quite frankly, I think we fancy ourselves democratizing a lot of really good institutional process on some of these dynamics and making it available for all investors, because that's something that's really important to me. It's really democratizing this industry in general. Certainly as someone who grew up on the outside looking in. And then lastly, I'm on Twitter. I'm fairly prolific at Twitter at 42 Macro, Dale, DDALE.
All right. Thank you very much. We appreciate it.
Thank you.
Appreciate y'all, man. Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.